get started. So today we're going to talk about the money market and monetary policy, and this is chapter 9 in the text. Okay, so, and I just want to check everyone can hear me okay? Perfect. Okay, so we're going to first talk about the money market. So we're just doing a very simple, just to get the idea of what a money market is. So we learned last time that money functions as a means of exchange, store of purchasing power, and a unit of account. The money market is an economic model that's describing the supply and demand for money in an economy. And the model is useful to understand how interest rates, the price of money. Well, so the interest rate is the price of money, right? How exactly are these things determined? And this, we'll get an understanding of the money market, which will help us understand a number of the policy tools used by the central bank, because the central bank intervenes into the money market to essentially stimulate or destimulate the economy, as we'll see. So there's different policy tools that the Bank of Canada uses, and they're related to the money market. So we need just to have a basic idea of what a money market is. And so we're thinking of the demand and supply of money, and the interaction of demand and supply will determine the interest rate and the amount of money. So, typically, the supply of money is fixed. We're going to just assume it's fixed by the central bank. And the demand for money is related to those functions of money. We need to have money in our checking accounts and in our pockets, so currency in circulation, to be able to buy stuff. And there is a relationship between that and the interest rates, as we'll see. So first, let's just talk a little bit about the Bank of Canada. Someone's asking about the deadline for the survey. I'm not exactly sure. You should have gotten an email about it. But it only takes a few seconds, so if you can complete it, anytime, that would be much appreciated. You can do it after the lecture if you like. So the Bank of Canada was established in 1935, so it's been around since then. It's a wholly government-owned institution, and it has four main functions. So it acts as the banker's bank, so the commercial banks like CIBC, it's a bank for those banks. And it's also a lender of last resort. It also acts as the federal government's fiscal agent. So it provides different financial services to the federal government. And one of its main functions is to ensure the stable operation of financial markets. And then the fourth, which is where we're focused on in this lecture, is that it's the regulator of the money supply. Okay, so the most important role of the Bank of Canada is to control the money supply, and it has three main goals when doing that. First is to minimize inflation in order to preserve the purchasing power of the dollar. The second is to maintain real output as close as possible to its potential level. So again, we see that this government agency also has an incentive to want to do certain things in order to keep the economy close to potential GDP. And it wants to minimize any fluctuations in aggregate demand and that sort of thing. If you think of the business cycle, the government in terms of fiscal policy and monetary policy, the goal essentially is to smooth out that business cycle the best as possible. And it's also, it's one of its goals is to make sure that the external value of the Canadian dollar on the foreign exchange market. So it's regulating that. Okay, we'll talk more about that later. And so the Bank of Canada, and just to note, when we say the bank and it's capitalized, we're referring to the central bank. And in Canada, that's the Bank of Canada. So the bank issues paper currency and affects the activities of chartered banks to adjust the interest rate and the supply of money. The bank decides and implements monetary policy. So let's talk about this money market. Okay, so there's a supply side and a demand side, like any other market. We're just going to be thinking about the definition of M1 for money. Okay, so just demand deposits and currency in circulation. And so the supply, then, we're just going to think of it as being fixed when we draw the diagram. It's representing the level of M1. Now, the demand for money has two components: asset demand and transactions demand. Okay, we'll talk a bit about those in a moment. And so the interaction of supply and demand will determine the interest rate. And so the interest rate is essentially the price of money. It's essentially, if you're holding money in your checking account or in your pocket, there's an opportunity cost of doing that, and it's what you give up, which is potentially the interest rate. right? So that's basically what the price of money is. It's because you're holding it, you're not getting any return on it in the form of interest rate. So the price of money then is the interest rate, and that's what is sacrificed or the opportunity cost as a result of holding money in your pocket or in your checking account. Okay. So in other words, the cost of holding money is equal to the interest that is foregone. So in this model, again, this is just a simplified model. In this model, we're going to assume people hold money in either money or bonds. Okay, so we have this setup where people can either keep their money in their pockets or checking accounts, or they can put it into bonds, which will get some sort of a return in the form of an interest rate. So the supply of money, we're going to say, is just determined by the Bank of Canada. We're going to represent that with just a fixed line at some level of money. Okay, so that's the money supply. So we're saying that it's essentially determined by the Bank of Canada, so it's not related to the interest rate. And just to note, so when we're talking about the money market, we're looking at the interest rate and quantity space. This is the price of money, and then this is the quantity of money. Now, we're thinking of this value as referring to M1, okay? We're saying it's the money supplied is always perfectly, well, I guess we should say perfectly inelastic and stays at a constant value, which is shown through the vertical supply curve. So this would only shift if the government decision makers decide to change the money supply. Okay, if it increases, it shifts to the right. If it decreases, it shifts to the left. There might be a little typo here. So if we shift this to the right, that's an increase in the money supply. If we shift it to the left, that's a decrease in the money supply. So maybe just make a note of the correction there. Okay, so now we're going to talk about the demand for money. And as we said, there are two types of demand for money. This is called the transactions demand for money. And this refers to the desire to hold money as a medium of exchange. So we can use it to buy stuff, right? For transactions. And this will shift based on the levels of real GDP and prices. So we'll get a little bit more into that. But we're not going to say this doesn't necessarily, well, in our model, we're going to say that this does not change with the interest rate. Okay, so in terms of the interest rate, this is fixed. The things that would change this is the level of real GDP and prices. If you think of the prices doubling, everything else constant, we would obviously need to have more money in our checking accounts and in our pockets to buy stuff. If an economy is larger or grows, we're going to need more money. But there's no relationship here with the interest rate. So on our diagram, this will also be just a vertical line. But the asset demand for money refers to the desire to store money as a precaution or when the current return on investments is low. Just think of the relationship between the interest rate and how much money you'd want to hold. If the interest rate in our model on bonds is very high, that means there's a large opportunity cost of not having your money in bonds, right? Because you're giving up the interest rate. So there is an inverse relationship to the amount of money you want to hold and the interest rate. The higher the interest rate, the larger the opportunity cost, so the less amount of money people would want to hold, okay? So on a diagram, again, we're in the interest rate quantity of money space. So the transactions demand for money is just going to be some fixed number. Fixed amount is related to how big the economy is. So it's related to the real GDP, and it's also related to prices. The higher the prices, the more money you need to buy stuff. So it's unrelated to the interest rate. And again, the things that do affect it are real output and the price level. So any changes in the transactions demand for money will affect the amount of money demanded. So what we're after here is the total demand for money curve, which consists of these two components. So this is the first component. Now the asset demand component, we said there is an inverse relationship. So we're saying that the higher the interest rate, the less amount of money people would want to hold because they're giving up, the higher the interest rate, the larger the opportunity cost is. So if you can get a higher return, you're going to be more likely to not want to keep your money in your checking account or in cash. So again, if the interest rate increases, we'll get into this relationship here. But if interest rates increases, that is, people will want to hold less of their money because they can get a much higher return. Okay, so we're going to combine the two curves together now. So we have our transactions demand for money, which is this curve. We have our asset demand for money. So what we're after is just the total demand for money, which is going to be the sum of these two. So at any interest rate, we're going to add the transactions demand, which will always be the same, the asset demand for money. Okay, so the total demand for money will be this distance here plus this distance here. Okay, so for example, at 5%, we have that the transaction demand for money is 10 million, and at 5%, the asset demand for money is 20 million. So then the total demand for money at 5% is 30 million. And so if we did that for all the different interest rates, we would get the total demand for money curve. Okay, so the total demand for money curve is the sum of transactions demand and asset demand. In summary, the demand for money is determined by the level of transactions. So this relates to the transactions demand for money. So that's real GDP or overall income. And we said it's also related to the price. Okay, so these two are related to the transactions demand for money. And then the third, the interest rate, relates to the asset demand for money. So the total demand for money then is determined by all three of these different things. So we could write it more succinctly by saying the demand for money is a function of real GDP or income, prices, and the interest rate. And the direction or the relationship is positive. So higher income, higher demand for money, higher the price level, the higher the quantity demanded of money, the interest rate, and then the interest rate itself, there's a negative relationship. So the higher the interest rate, the lower the demand or quantity demand of money. Less people would want to hold their money because the opportunity cost is higher. Okay, so let's look at an equilibrium. So like any other market, we say that there's a tendency for the market to clear at the price associated with the intersection of the demand and supply curve. And there's a reason why we say that, and it's because if the price, here the interest rate, was something other than this, we're either going to have some sort of an excess demand or excess supply or shortage or surplus. Okay, so if the interest rate was actually higher than this equilibrium, that means that the supply of money, the quantity supplied of money is larger than the quantity demanded of money. Okay, so we would have a surplus of money. And so in this case, what will happen is that the interest rate will fall and go down here. Okay, but we're going to introduce the concept of what bonds are, how the prices of bonds are related to this sort of thing. So we'll get a little deeper of an understanding of why we think this interest rate would fall, and we'll do that in a moment. Okay, and so if the interest rate is below the equilibrium, we have the opposite situation where we have the quantity demanded of money is higher than the quantity supplied. And so remember, at a very low interest rate, the opportunity cost of holding money isn't so much. So more people prefer just to have it in their pockets. Okay, but in this case, we would have a shortage. Okay, and so in this case, there would tend to be a situation where the interest rate would increase and go back towards the equilibrium. So let's just do a quick question here to test your understanding. So let's assume that the asset demand for an economy is shown below. So this is the asset demand for money. And we're told that if nominal GDP is 800, transactions demand is 10% of nominal GDP, draw the total demand. So I'll let you think about that for a sec. Okay, so someone tell me then, okay, what are we after here? We're after the total demand for money. So at each interest rate, we need to know what the total demand for money is. And that consists of two components, the asset demand and the transactions demand. So we know the asset demand for money at every interest rate. That's indicated here on this curve. Where do we get the transaction demand? So what is the transactions demand for money for this economy, given the information here? Can anyone tell me about that? What that would be? So we have one response. Yeah. Okay. Perfect. So everyone agree that it's 80. So basically, this information here tells us that this economy has a nominal GDP of 800, and it's saying that 10% of nominal GDP is the transactions demand for money. Okay, so at any interest rate, we have that the transactions demand for money is 80. So we're basically going to be just adding 80 to the asset demand for money. So at, for example, 10% interest rate, the transaction demand for money is 80, and the asset demand for money is so 80 plus 60 will equal 140. And so point on the total demand for money curve would be here at 10 and 140. And then we do a similar exercise for all the other interest rates, and we get our total demand for money curve. Okay, does that make sense? So we're basically just shifting the demand for money curve to the right by the amount of the transaction demand. If the money supply were 150, draw in the money supply curve. So where would I draw that in? It's a vertical line. Where would I draw the vertical line? Does someone wanna? It would be at 150. So that would be our supply of money. This is our total demand for money. What's the equilibrium interest rate and quantity of money? Well, it's going to be where these two intersect at 8% and 150. Only at 8% will everyone be happy in a sense, where the quantity supplied equals the quantity demanded. And so there's no shortage or surplus. If the interest rate were 10%, would there be a shortage or surplus of money? And by how much? Does anyone want to give that a shot? That's right. So we would end up with a surplus. And so at 10%, there's going to be more people that would want to hold their money in bonds rather than in cash. And so we would have a surplus of money here, and the interest rate would tend to fall. And we'll talk about why that's the case soon. And the amount of the surplus here would be 10. So how does this money market adjust? Okay, so how does it adjust to a surplus or shortage so it will do that through bond yields. Okay, so we're just going to talk a little bit about what a bond is, and just to get the idea of the relationship between the interest rate and the price of bonds. So if there's a surplus of money, people would want to buy bonds. Okay, and that's again where the interest rate would be higher than the equilibrium. So there's a larger opportunity cost of holding money, so more people would want to buy bonds. Okay, and again, in this model, we're assuming people can only hold either money or bonds. If there's a shortage of money, in that case, people will sell bonds. Okay, if there's a shortage of, people, when the interest rate's low, opportunity cost of holding money isn't as high, so more people want to hold on to their money. And so if it's below the equilibrium, then we have a shortage of money because the demand for that fixed amount of money is more than the amount that's available. And so in that case, we know that the interest rate would go up, but how? Why? Okay, so remember, if there's a surplus, we have people wanting to buy bonds. If there's a shortage, people want to sell bonds. Okay, but what's a bond? Let's talk about what a bond is. So this is what a bond looked like back a long time ago. Of course, everything now is electronically. You could probably still get maybe a printed version like this. But let's just go over the basic idea. So if we look at this is a bond, and the face value is 1,000. Okay, so whoever issued this bond, in this case, it looks like it was the state of West Virginia. So here, this would be, the state of West Virginia have issued a bond because they need money. So they need to borrow money. And what they do is they issue bonds. And so you can think of this maybe as a contract. So whoever gives them $1,000, so you can think of someone who buys this bond, they're giving them, they're going to pay $1,000 for this. So the state of West Virginia is raising $1,000. They're borrowing $1,000 from whoever buys this. And every year, they're going to get a certain amount of interest payments. And these are called coupon payments. And you can see these are like little coupons, okay? And so the person could just take this off and get that, interest amount every year. Usually, I'm not sure why these are different numbers, but usually with a bond, it will be the coupon, there'll be a coupon rate. And say if it's 10%, then here the coupon payment will be $100 every year. Okay, and so how a bond works is that the person who buys this gives them $1,000. They're going to get their $1,000 back at the end of the bond. So however many years it takes to maturity, there's different maturities for different bonds. So here it looks like there's 1, 2, 3, 4, 5, 6. 1, 2, 3, 4, 5, 6, 7, 8, 9. So 6 times 9 years. So that would be how many years to maturity. So that's how a bond works. Basically, the person who buys the bond, gives the, and we're thinking here about the initial offering of the bond. So initially, the person would pay the face value. And so the government here would be getting that 1,000. That's the money they need to borrow. And every year the government will give this coupon payment. And this coupon payment's fixed too, and it's based on the face value of the bond. That's important because we need to think about later on, because these things can be traded on the market. But initially, the face value is what's borrowed. The person pays the face value. And if they hold this bond to maturity, they'll get all of those yearly coupon payments and they'll get their $1,000 back in the end. Okay? That's how a bond works, generally. So they're basically loans for a set period of time. And they don't necessarily just need to be issued by the government. A lot of times corporations will issue bonds. So there's corporate bonds and there's also government bonds. There's different types of government bonds. There's municipal bonds. If the city government raises money, provincial bonds, federal bonds. So all bonds have a set face value. Okay. And so that's initially what was borrowed by whoever issued the bond, pays a fixed rate of interest, which is called the coupon rate. Okay. And again, the coupon rate, if it's 10%, that means the fixed rate of interest yearly would be 10% of the face value, which in this case would be 100. And now it's important to note that these can be bought and sold in the market. Okay. So at the time this is issued, coupon rate is usually based on the prevailing interest rates in the economy at that time for a similarly risky investment. Okay. So for if at the time the bond's issued, the prevailing interest rate is 10% for similarly risky bonds, then that's how the coupon rate would be determined, right? So if it's 10%, then that means at that time period, when this was initially issued, that's generally what the interest rate is for that type of risky bond. But obviously over time, over the course of the bond, the interest rates in the economy can change. And I mean, if you look at them now, they're extremely low. So a coupon payment of 10% would be, amazing, right? It would be very, very high. So then price of this bond, if you were to have bought this bond, suppose you got this bond, you paid 1,000 and you get claimed to a 10% return on that 1,000 every year. Let's say the interest rates in the economy now are 1%. Bond is going to be worth a lot more than $1,000, right? Because the general interest rates in the economy are, say, only 1%. But this thing's giving 10%. So you could sell this bond at a premium. So when you're talking about the secondary market, the price of the bond will change, and it will change such that the overall yield or return on this thing will be consistent with what the general interest rates are in the economy. So the return or yield on a bond depends on the coupon rate and the profit or loss from its sale. So bond prices will adjust to reflect the return on other financial instruments with similar risk. And the higher the price, the lower the return or the interest rate. So if you were to take a finance course, there's a lot more complexities here. We're just going to keep things simple though. And so we're going to say that the rate of return on a bond equal to the coupon interest that you're going to get, plus or minus the change in the bond price. So think about buying one of these bonds, paid a certain price for it, and after the initial offering of the bond, and it can trade in the bond market, and so the bond interest that you'll get on it is fixed, but the price that you pay for the thing is not necessarily going to be the face value anymore. It depends on the general level of interest rates in the economy. So you could buy the bond at maybe buy it below face value or above face value. And then while you're holding it, the price of it can change as well when you go to sell it. Okay, so your return then is composed of two things: this fixed coupon interest, and then plus or minus the change in the bond price. So we're thinking here of, how did you paid a price for the bond, how did that change? So that difference, and that could be, you could lose or gain money on that. And whenever we're talking about a rate of return, generally we're usually thinking about what you're going to get and then divide by what you had to pay to get that. And so we divide that by the price you paid for the bond. Okay. Now, let's look at some examples. So we're going to just keep things simple and suppose that you're going to buy the bond and hold it for a year. Okay, so here we have a bond. Its face value is $5,000 and has a 4% coupon rate. So the fixed payment that the holder of this bond is going to get every year is how much? Does someone want to type that in the chat function? Yeah, exactly. So it's 200. Okay, so let's look at some different scenarios. So let's suppose that the bond was purchased at 4,700, and we're going to assume that there's just a 1 year maturity. We have 1 year left to maturity. So if someone buys this for $4,700, okay, and then they hold it for the year, and at the end of the year it's matured, and they're going to get that face value back, okay? So if that's the case, if you bought this for $4,700, hold it for a year, at the end of the year, you're going to get $5,000, the face value back. So in this case, you're going to make $300. That's the second term here. And then you're going to get that $200 coupon payment. And what did you pay to get this? You paid the price of the bond, which is $4,700. So in this case, the return is 10.64%. Okay. Suppose instead, though, that you paid $4,900 for it. If you paid $4,900 for it, you're only going to get $100 in terms of a capital gain off just the difference in price. You're always going to get this fixed $200, and then you divide that by what you paid, and in this case, the return or yield would be 6.12%. And then if the price were $5,100, so you've paid a premium for this, and again, you might do that because the interest rates in the economy are really low, and so this actually would be fine with that. So in this case, if you pay $5,100, when it matures, you're only going to get $5,000, right? So you're going to lose 100 off the difference in price. You're still going to get your 200. Divide that by what you paid to get it, and you would get 1.96%. So the key thing here to realize is the relationship between the price of the bond, the interest rate. So the higher the price, the lower the interest rate. So you can think of, if people are wanting to buy bonds, bid up the price, and that will cause the interest rate to fall. So going back to our money market, if we have a surplus of money, then we're in a situation where people want to buy bonds because they want to reduce their liquidity, and the opportunity cost is very high of holding money. So in the process of people buying bonds, bond prices will rise, and given what we just learned, that will lead to a fall in bond yields and interest rates. So if we have a surplus, the interest rate will tend to fall because of that reason. So now we know why that the interest rate would fall, and they'll fall until there's no more surplus. If there's a shortage, it's just the other way around. People will sell bonds in order to increase their liquidity, and in the process of doing that, that will cause the bond prices to fall, which will drive up the yield and the interest rate. Okay, and that would happen until there's no more shortage. So if we were to think about, and if we go back, if you remember, we had the diagram where our money market, total demand for money, this is the money supply. And so if the interest rate was above, we have a surplus. And so in this case, people are going to want to buy bonds, and what they're going to do is drive up the price of bonds, which lowers the yield. So we go back down. If we have a shortage, we have that people want to sell bonds, that will drive up the price. So that's so now it's more clear about what's going on and why the interest rates would change when we're not at the equilibrium. Okay, so here we have, so if we're thinking of a money market, I'm not sure why in this case they have an upward sloping supply curve for money. Just ignore this slide, okay? The main idea here is that if we look at our money market, right? If you were asked the question, what two shifts could result in an increase in the interest rate? Well, an increase in the interest rate could happen because of the demand for money shifting to the right, because then the new equilibrium, we've got a higher interest rate, or the money supply could be reduced, and then you're going to go from here to here, and that would increase the interest rate. Okay, let's again do a do an active learning question. So if the money supply was 150, what would be the equilibrium interest rate here? Anyone? Exactly, it would be 8%. We're going to look for where the money supply is equal to the total demand, and that's at 150. If the money supply were 140, what would be the equilibrium interest rate? 10, perfect. If the interest rate is 11% and the money supply is 150, what's the implication? That's right, good job. Yeah, we would have a surplus. What would be the amount of the surplus? 15. Okay, good. So now we're going to switch over to monetary policy. So monetary policy is designed to change the money supply, credit availability, and interest rates, and it's the responsibility of the Bank of Canada. In a nutshell, the Bank of Canada can intervene in certain money markets to affect the interest rate, and the reason why they would do that is the interest rate in the economy is the cost of credit. If the interest rates are very low, that means it's cheaper for people to borrow to buy things, and it's cheaper for businesses to borrow to invest. And, that's why as soon as this COVID-19 thing started to happen, the Bank of Canada did things to reduce the interest rate substantially, and they did the same thing in the financial crisis. Okay, so the reason why they do that is to stimulate the economy, and since they're able to control it, that's what will happen. And again, this is the responsibility of the Bank of Canada. Fiscal policy that we talked about before was the responsibility of the Department of Finance. So an expansionary monetary policy would be a policy that would aim to increase the amount of money in the economy and make credit cheaper and more easily available. Contractionary monetary policy would just be the opposite. It would be a policy in which the amount of money in the economy is decreased and credit becomes harder to obtain and more expensive. One of the most important tools of the Bank of Canada is called open market operations. And the idea here is that the Bank of Canada will go on the open market and buy or sell securities. Okay, so the Bank of Canada can go on any market and just buy stuff like anyone else. And we'll talk about why, what that is in a moment and how it affects the money supply. Another policy would be to switch government deposits. So we said earlier that the Bank of Canada is the fiscal agent for the government. Well, so the money, the government's treasury or, the money that they hold can be held at the Bank of Canada, or it could be in accounts at the commercial bank. So the Canada could, instead of having that money deposited with them, they could deposit it in commercial banks. They could transfer the deposits from a commercial bank to the Bank of Canada or the other way around. So the idea there is if they want to, if the money held at the Bank of Canada, if it's held there, it's not part of the money supply. But if it's part of the commercial banks, then it is. If you remember from our last lecture, we talked about the money creation process. Well, remember, if there's excess reserves in a commercial bank, they want to lend that out. So basically, these policies are just doing things to increase the excess reserves that commercial banks have in the hopes that they'll lend the money out and that will increase the money supply. And we'll talk about, so these are all related, but there's the targeting the overnight rate, which we'll talk about later. That's one of the most important policies, and that these aren't mutually exclusive. The targeting the overnight rate is related to open market operations, as we'll see. Well, again, let's focus more on this open market operations. So think about the reserves on commercial banks. So one simple way the Bank of Canada could increase commercial banks' cash reserves would be to give them additional amounts of reserves. So, however, some of us might complain about a free gift of cash to the banks, but that's not exactly what they do. So what they do is it's more subtle. It's a business-like process known as open market operations. So this involves the buying or selling of, it could be any securities. Especially in recent times, they've been doing things where they're buying not just government bonds, but they'll buy corporate bonds and things like that. So basically, the idea is that the Bank of Canada will just go on the open bond market, start buying bonds or selling them. And so why does that matter? Well, think about if the Bank of Canada buys a bunch of bonds in the open market. Well, that will result in money So the Bank of Canada is going to buy a bond. Whoever sold the bond to them is going to get some money from the Bank of Canada. So that's new money into the system. They're going to deposit it at their bank. And so the idea is there'll be more excess reserves in the commercial banking system. And then the other way around if they sell bonds. Okay. So just this last point here, the Bank of Canada buys and sells government bonds in the same way that any individual or corporation might. It should be noted that these are secondhand bonds, previously issued and sold to the public. So we're only talking about the secondary market here. We're not talking about anything about initial offerings of bonds or anything like that. So this is a good illustration of the whole process. So it should make more sense after we go through this. So in this example, let's start at point 1 here. And in this example, we have that the Bank of Canada is going to buy a T-bill from a corporation, and they're going to pay with a check. So a T-bill is it's not a bond, it's more of a short-term way that the government can raise money. So it's still like a loan or something like that. Basically, the government issues these to raise money. They're more short-term, but the idea is that the Bank of Canada is going on the open market and buying one of these things. Currently, a corporation owns it, so the corporation maybe needed to park some money in the short term, and they want to get a little bit of interest, so they buy T-bills. The T-bills are issued by the government, so they're very low risk. So the corporation was holding these, and the Bank of Canada came by with an offer they couldn't refuse, and so they sold it to them. So the Bank of Canada is going to pay the corporation with a check. Okay, so that's 1. Now 2, the check, so the private corporation is going to get the check. Okay, so if we look up here, we have the ownership of the T-bill is going from the private corporation to the Bank of Canada. The Bank of Canada is going to write a check. The private corporation gets the check. They're going to deposit that in their commercial bank. Maybe it's CIBC. Okay, and so that's 2. And then 3, the check is going to be the commercial bank is going to present the check for payment from the Bank of Canada. The Bank of Canada is going to pay them, give them the money. So now there's increased reserves in the commercial bank. And so if we go to 5, then, and we remember what we learned from last class, the commercial bank now will have increased reserves, and some of them will be loaned out. And we know that that will increase the money supply from our previous lecture. So that's the idea. So if they just go on the market and start buying a bunch of stuff, they're going to end up injecting a lot of money into the commercial banking system, and that will hopefully result in more lending, and it will result in lower interest rates, etc. So that's the idea of open market operations. In the real world, it's a lot more complicated than this, and there's different things. This is just the main idea, concept. And if you do want to learn a little bit more, you can actually go to the Bank of Canada's website, and they have all kinds of information on more specific details of this. And so this, if they wanted to reduce the money supply, everything here would just be the opposite. They would go and sell T-bills that they own. So they would have to already own, on their balance sheet, they would already have to own some of these. And so they would sell them, and then they would sell them at a price that people would want to buy them. And then they would be pulling money out of the commercial banking system. So the other policy too, this was just a simple thing where the Bank of Canada can decide where to have government money. So if they keep it at the Bank of Canada, it's not in the money supply. But if they deposit it at commercial banks, then it is, and that would mean higher reserves. Okay. So for instance, if the Bank of Canada wants to reduce the money supply, it can, with the approval of the Finance Ministry, transfer some of the government's deposits from a commercial bank to the Bank of Canada. So in this sense, now there's going to be less money in the commercial banking system. And so they would just write a check on the government's account at the commercial bank made payable to the Bank of Canada. If it wishes to increase the money supply, it would just do the opposite. Now, let's talk about the Keynesian monetary transmission mechanism. And now so we said basically that the Bank of Canada, if they wanted to stimulate the economy, they could do so by buying bonds on the market. Now, exactly how does that stimulate the economy? This is the Keynesian transmission process. So Keynesian's belief was that changes in the money market could also indirectly, via changes in interest rates or exchange rates, transmit to real variables in the economy. So first point here, if the central bank expands the money supply, again, they could do that with their open market operations. So they could be buying bonds from financial institutions. And so that will result in the interest rate falling. when the interest rate's lower and businesses would want to borrow more, for example, we'll just focus on business investment. Of course, consumers might want to buy more durable goods and that sort of thing. We'll just focus on business lending. If the interest rate falls, businesses would want to be able, it'd be cheaper for them to borrow more, and so there'd be more spending on investment projects like plants. And then if you're thinking of consumers too, people would buy more consumption goods. And so this will boost the economy. So that's the main idea. Okay, so the agent of change here is the Bank of Canada, and it has a degree of control over the supply of money, and then it can thus affect interest rates. That's the idea. So we basically are stimulating the economy through lower interest rates. And we're starting with the money market, making the interest rate lower, credit's cheaper, and businesses will want to invest more, and consumers would purchase more durable goods. So if we look at our model, this is how it would work. So the central bank would do something to increase the money supply. That would result in interest rates being lower. Okay. Now, lower interest rates mean higher investment. So here we have a downward sloping investment demand curve. So here all this is the relationship between the interest rate and investment. And we obviously think that that's a negative relationship, because the cheaper the interest rates are, the cheaper it is to borrow. And so the more likely firms would want to invest. And so lower interest rates means higher investment. Okay, so in this case, we have a decrease in the interest rate because the money supply increased. So the chain of events is money supply increases, that causes the interest rate to fall. That will cause investment to increase. Now, if we think back to our aggregate expenditures model, that will cause the aggregate expenditure function to increase, and real GDP will increase by more than that because of the multiplier effect. And excuse me, sorry. And that will shift the aggregate demand curve to the right. So we're obviously thinking here of a fixed price level. So at whatever price level we're fixed at, we have our aggregate demand curve would be shifting to the right by this amount, which is equal to this amount here. Okay, so that's the whole process in terms of the models that we've learned so far. So here's just another summary. So if the government increases the central bank increases the money supply, that'll cause a surplus of money. People will purchase bonds. That will cause bond prices to increase and the interest rates to fall. That will transmit into higher investment, which will shift the aggregate demand curve to the right. This is a contractionary example. So here, everything's the same except we're starting with a decrease in the money supply. That will cause interest rates to increase. We're going to move up to the left along the investment demand curve. So investment will fall. That will shift the aggregate expenditure curve down, and the economy, the real GDP will shrink by this much. And so at whatever price level is fixed here, we will have the aggregate demand curve shift over to the left here. So at any price level, we would have the same shift to the left. Okay, here's just a summary for your notes. And so let's think about if we were, so what does this diagram indicate? What's the gap here? Are we in a recessionary gap or an inflationary? Yes, that's right. We're in an inflationary gap. So in this case, the government would want to slow down the economy. So what would they do? They'd want to do contractionary monetary policy, and they would want to reduce aggregate demand, shift it to the left so that we're back at potential. So they can do that by decreasing the money supply. If we're in a recessionary gap, they would want to shift the aggregate demand curve to the right by increasing the money supply and making credit cheaper. Okay, so now let's switch over to what's called monetarism. This was popularized by the American economist Milton Friedman. He's more of he really likes free enterprise, less government involvement, so laissez-faire capitalism. That just means very free, less government intervention. And he claims that governments are inefficient by their very nature, and because they hinder individual freedom, their intervention in private markets should be minimized. And his most wide-ranging work was associated with the economic perspective known as monetarism, which emphasizes the influence of money in the economy. So they base their arguments in the context of the quantity theory of money. And one version of this is to look at this thing called the equation of exchange. So the equation of exchange is very straightforward. It's sort of an identity. So M is the money supply, V is the velocity of money, and that's how many times money is used. And that should equal the price times the quantity. Well, that's basically nominal GDP. So times Q is the money value of the national output in an economy, and that is equal to MV, which is basically the total spending on national output, and therefore it must equal PQ. So the quantity, this is just basically true by definition. Okay, so central to monetarism is the velocity of money. So, you have that exchange equation, it's very straightforward, and then they make some assumptions about, or what they think about those terms. So they believe that the velocity of money, which again is the number of times money is spent on final goods and services in a given year, you can actually, V is found by dividing nominal GDP by the supply. So again, if an economy had, if a very simple example, if an economy had just one $10 bill and it was able to, that changed hands 3 times and each time the value was $10, then the nominal GDP in the economy, total value of production, would be 30, and that's based off of a $10 bill. So the velocity would be 3, right? That money was used 3 times. And so basically we're just taking nominal GDP and dividing it by M, and that will tell us what the velocity of money is. This is the amount of money that was responsible for this amount of activity, economic activity. Suppose that Canada's nominal GDP is 1 trillion and M1 is 50 billion. Each of the dollars of the stock of money must have been used 20 times to finance this level of activity. So this is, so suppose that nominal GDP is 1 trillion and the money supply is 50 billion. Well, then, this is the amount of money that people could use as a medium of exchange. And so it must have been exchanged 20 times in order to get this. So that's just the simple idea. Now, also recall that nominal GDP is the total money value of all goods and services produced in the economy over a period. So GDP expresses both the price level and real output. And we know nominal GDP is that. So in other words, the $1 trillion in nominal GDP may be broken down into a price level of, say, 2 and real output of 500 billion. If that's the case, then the nominal GDP would be 1 trillion. So we can say that maybe the price level is 2 and then the quantity is 500 billion. So when we multiply it, we get 1 trillion. What change in M does to P, however, is a matter of debate. So the controversy centers on whether and how V and Q are affected by changes in the money supply. So the monetarists argue that in the long run, V is determined totally independently of the money supply. So they're basically just saying that the velocity of money, so how many times it changes hands, is fixed. Okay, so if that's the case, then a change in M leaves V unaffected, but brings about a corresponding change in expenditure in the economy. So we'll show that with the formula in a sec. But therefore, they claim that the monetary policy over the longer term is an extremely powerful weapon for controlling aggregate demand. So they also see this monetary transmission mechanism differently. They hold that this mechanism is more powerful than what the traditional Keynesians believed it to be. So they assume that individuals only demand money for transaction purposes. So they don't really buy this asset demand for money idea too much. They're saying that's irrational for anyone to hold idle balances of money for any purpose. So basically, their arguments just say, if we summarize them, they just mean that the demand for money curve will be relatively steep, right? Because remember, the money demand curve consisted of the transactions demand, which is vertical, and then the asset demand for money. So they're saying the asset demand for money isn't really all that big of a deal. And so we're thinking more of just the transactions demand for money. So that was like a vertical line, but we're just going to say that it's not perfectly vertical line. It's just very steep. Okay. So, that's the idea there. So they also believe that firms are very sensitive to interest rate changes. So an increase in the money supply would cause a big drop in interest rates and a significant increase in investment spending and consumption goods. And so what does that imply? That implies a more elastic or flatter investment demand curve. So there's a little change in the interest rate that will lead to a very large change in investment. So the Keynesians' assumptions were that it was different. They said it was quite sensible for people to hold cash as an asset. So if the money supply curve were to increase, there'd be little effect on interest rates, and only a drop in interest rates is required for people to be comfortable holding increases in any amounts of money. So basically, we have monetarists say that the money demand curve is steep. These guys say that it's flatter. And in terms of the investment demand curve, Keynesians think that it's steeper, and the monetarists think that it's more flat. Okay, and so that'll result, basically, we'll see on the diagram the differences. This is just going to mean that transmission mechanism is going to be more powerful for monetarists than Keynesians. So for Keynesians, consumer demand for money is elastic on interest rate changes. So anyways, well, let's just look at the Keynesian idea and then the monetarist idea. So for Keynes, they believe in this asset demand for money more, so that results in a flatter money demand curve. Okay, so for a given increase in the money supply, the interest rate will not fall as much as we'll see for the monetarist. So, in this example, it falls by 1%. They think that the investment demand curve is not very, it's more steep than the monetarist. In this example, that 1% decrease in the interest rate leads to a 5-unit increase in investment. So monetarists, on the other hand, think that this is very steep. Okay, so for that same change in the money supply that we looked at before, the interest rate would fall by a lot more. Here it goes from 6 to 2%. And then they also think the investment demand curve is very flat. Okay, and so for that interest rate decrease, the quantity of investment will go up substantially from 25 to 65. So obviously the end effect on the GDP will be much larger here. So, just in terms of the bottom line, the same $20 billion increase in the money supply would increase investment spending by a meager $5 billion according to the Keynesians in this example, by a whopping $40 billion according to the monetarists. So this is just a sort of a summary of the different ideas here. So I put this, here for you to read for your notes. Now, so up till now we talked about, or we assume that the government actually targets and focuses on the money supply. Okay, but clearly the Bank of Canada cannot control the creation of loans by the commercial banks. So they could target the money supply, but they're not going to be very good at targeting it because it's not exactly in their control. Because again, that money creation process is done by the commercial banks. And also, in reality, the slope of the money demand curve isn't very certain, and the position of the money demand curve is uncertain. So in terms of just the bottom line here, a policy of targeting the money supply to change economic activity is not practical as it can't be done with accuracy. So this was done before, say, maybe the 1990s, but in recent decades, they target the overnight rate. So now we're going to begin talking about this targeting the interest rate, which is a better option. So it's like the same chart. It's just sort of where they focus their attention. So suppose that the present equilibrium is 3%, we have our quantity demanded of money at Q1. Targeting a rate of 4% require a reduction of the money supply to Q2, the drop in the quantity demanded. So basically we're saying here, instead of the bank kind of focusing on this, saying, okay, we want the money supply to be this amount, and then that will lead to a certain interest rate. This is hard to do, right? Because you need to, I guess, estimate how the commercial banks would go about creating loans, how much they would. So it's very hard to just focus on the money supply. It's much better to say, okay, what level of interest rate do we want in the economy? We can decide on that based on the economic conditions and, the lower, if we want to stimulate the economy a lot where we need to because we're in a deep recession, well, then we'd want a lower interest rate. And so basically the focus is on targeting the interest rate, so determining what interest rate we want the economy to have, and then just accommodating the money supply. Get that? Okay, and so this is a more accurate way of doing it. Okay, so the bank would then accommodate this change in the money supply by reducing what they can accommodate it. They can say, okay, we're going to buy this many bonds on the money. They'll do the market operations, and then they can see how that would affect the interest rate. It's a better way of doing it. So by the late 1980s, the Bank of Canada, along with many other central banks, abandoned this Keynesian monetary policy. It rejected both Keynesian and monetarist policies for emphasizing the money supply as the key variable. So instead, they began to target interest rates directly as the main policy variable. And in addition, they restricted its own role to that of controlling inflation rates. So they use the target the interest rates directly, and then they use this also to make sure that inflation is under control. Okay, so now what interest rate do they actually target and why? So they target what's called the overnight rate. Okay, so this is the rate commercial banks charge each other on overnight loans. So you can imagine that at the end of the day, banks will have excess reserves or insufficient reserves after checks have been cleared, right? Customers are writing checks to each other and other transfers and stuff like that. So at the end of the day, some banks will have a surplus and some will have insufficient reserves. And so they just need to borrow temporarily to clear that out. And so this, here you have a supply and demand, but it's just overnight. So it creates a very short-term market for loans. And then the price of this market is, of course, the overnight interest rate. So this is the main tool used by the Bank of Canada to conduct monetary policy. And we also call this the policy interest rate. The bank changes the target for the overnight rate. This affects other interest rates in the economy. So they tend to all be sort of related. So what they do is they come up with a target. So they meet about 8 times a year, and then they determine whether they should change the target or not. So suppose they decide that the target for the overnight rate should, we'll get to that in a moment. Someone just asked how do they balance it. So let's talk about this overnight rate here. So if their target is, say, 2.5% in this overnight market, what they'll do is they'll set the bank rate at 0.25 percentage points higher. The bank rate is the rate the commercial banks pay to the Bank of Canada on loans. Okay, so setting this bank rate means that in this overnight market, the interest rate will never be higher than this because commercial banks would never have to pay higher than this to borrow money, right? So that's an upper bound. Now, on the bottom is the lower bound. This is the banker's deposit rate. So the Bank of Canada will pay 2.25 an interest rate of 2.25% for any commercial banks who have excess reserves. So then the commercial banks would never accept anything less than this, right? So this puts a bound, and then basically it's restricting the trading to be in between here. So the commercial banks will trade with each other range. So, and again, they're setting, the reason why this is an upper bound is because no commercial banks are going to want to pay a higher interest rate than what they can get from the Bank of Canada to borrow. And if they have excess funds or excess reserves, they can always get 2.25% on it from the Bank of Canada. So they wouldn't accept anything less. So this confines that overnight market. And then, so, the interest rate here could be here. It could go up and down in this range. If it starts to, say, get up close to the 2.75%, then the Bank of Canada would use something like open market operations to hit that back down again. And if we look, do quite an amazing job at keeping it within those bounds. So if you look at this diagram, this is from 2000 to 2014. The red is the actual overnight rate, and then the green is the target. So, of course, it's extremely, very, very highly correlated. You can see with the financial crisis how quickly the overnight rate dropped. I'll have to update that for the latest COVID. So, this is just a little bit more recent data. on the overnight rate. So the overnight rate was about 4.5% in 2007. Then it dropped a lot because of the financial crisis, stayed very low. So it was only at 0.25%. Then it went up a bit. And then for whatever reason, they kept it the same for quite a few years, dropped it a little bit here, and then it went back up to about 1.5% in 2018. So we're just going to talk for a quick moment about anti-inflationary monetary policy. So the bank now targets the interest rate rather than the money supply as its main tool of policy. Okay, so we established that. However, more significantly, they changed their goals. So their goal is to contribute to solid economic performance and rising living standards for Canadians by keeping inflation low, stable, and predictable. And it's going to use this tool to accomplish that. So they do, and inflation's not a good thing, right? If it's not predictable, it causes all kinds of uncertainty for businesses, and it's best just to have a very low, stable, and predictable inflation rate. Okay, so they've determined that that's the best thing for long-term growth. So in a nutshell, back in the 1990s, 1993, they decided to keep inflation between 1% and 3%. Okay, so they decided they're going to do everything they can using their interest rate tool to keep inflation between 1% and 3%. So they basically made it clear that the target range, this target range would be going forward. This is what we're going to do for a long time. So again, the reason why you would do this is the underlying purpose of preserving the internal and external value of a country's currency is to create the right atmosphere for investment. Firms don't like uncertainty. So having a stable, predictable inflation creates the best environment for businesses and investment. Basically realized two things. First of all, high inflation is costly for individuals and damaging for economies. We did have quite high inflation before the 1990s, especially in the 70s and 80s. And so inflation is one variable on which monetary policy can have a systemic and sustained influence. And clearly we can see that they've been very successful at that. If you look at inflation before the 1990s, you can see quite erratic, right? And it went up to as high as almost 13% in the early 80s. I don't know if you have relatives that had bought a house in this time. You might remember hearing them talk about the interest rate on their mortgages were almost as high as what the credit card interest rates are now. So, it was quite, this wasn't very good, having inflation jump around like this. And if you look here, we can see after the 1990s, the inflation rate is right in between 1% and 3%. And, they've been doing that for quite a while. And so we can reasonably predict that that's what inflation will be in the future. And you even see sort of a decrease in sort of the unemployment. It seems to be this may have helped too with smoothing out the business cycle, because the unemployment rate has, been relatively stable. Even in the financial crisis, it only jumped up to just over 8%. Actually, right now, the unemployment rate could be something like 20%. It's just very unprecedented times right now with this COVID. Of course, it's a much different situation. There's nothing really broken in the economy. We were forced to reduce economic activity. So nothing was really broken, but like the financial crisis, there was some things broken. There was, there was a bubble. There was incorrectly valued assets, and, the whole issues on the housing market. There was all kinds of things that went wrong there. So anyways, it'll be interesting when we see some of the newer data that's going to come out from this COVID event. We're going to see very different things here. But I mean, I don't think that nothing will say that this is a bad idea to keep interest rates targeted between 1% and 3%. Okay, so, and just one other thing we just want to touch on is how the policy of the central bank relates to the trade. Okay, so we know that if the government does a tight monetary policy is the same thing for a contractionary monetary policy. And so we know if the government aims to do that, they're aiming to increase the interest rates. Okay, and then we know this thing here, we know the transmission mechanism is related here. that would lower investment, slow down aggregate demand, and reduce inflation, because that's what we would be worried about with a tight monetary policy. But now, is that consistent with what would happen in the when we're thinking of the exchange rate and exports and that sort of thing? Well, if the interest rate's higher, that will tend to appreciate our dollar. Okay, and that's because if we have higher interest rates, that will attract foreign investors, and they'll need to buy the Canadian dollar to buy those higher interest rate investments. So that increases the demand for the Canadian dollar and appreciates its value. So that will lead to a higher exchange rate. It will cause lower net exports. If our exchange rate is higher, then we're going to tend to import more, and people won't want to buy as much from us because it's more expensive. And so our net exports will fall. And so that will lower aggregate demand. And in this case, that's what we want because it's a tight monetary policy. So bottom line is what goes on here in terms of exports is consistent with the policy that the government can follow. So if it's tight, it'll result in lower net exports. If it's a loose monetary policy or expansionary, it will result in the currency depreciating, which would increase net exports. So they're consistent. Okay, so let's just finish up here. Actually, we're getting close to the end of class, so I think actually this would be a good homework question for you to do, and then we can I'll take up any questions at the beginning of the next class. Okay, so I'll end there, and then before I go, I'll just see if anyone has any quick questions. Everyone okay? So yeah, Basil, you're saying why do they have to balance it? So can you just be a little more clear on what you mean by that? So in terms of what? So what do you mean by, you're talking about why they need to balance the reserve? So I mean, I'm not sure what you mean by balancing the reserves, but when we talked about open market operations, that ended up providing more money in the commercial banking system because their excess reserves are going to be higher now. And so we know from the last class then that they would likely want to loan some of that out. And so that would increase the money supply. So I'm not too sure what you mean by balancing out the overnight. So sure what balancing is going on in the overnight market. How about this? Maybe just send me an email with the question. Yeah, with maybe a little more clear, and then maybe you can indicate what slide that you're referring to. I can answer it for you. How does that sound? Okay, so yeah, we'll call it a day, and we will discuss next class. Actually, let's bring up our weekly schedule just to make sure we know where we're going. So we're going to switch over now to international trade next class, and then we're going to talk about exchange rates and the balance of payments. Okay, so the next two classes we're switching over to, we're thinking not just of Canada now. We're going to think about how Canada fits in with the rest of the world. What are some of the economics of trade? Why should we trade overall beneficial? And we'll talk about the foreign exchange market and that sort of thing. Okay. Yes, Paulina, I'll take a look. No problem. I'll take a look and get back to you. Well, thank you for attending the class. Unfortunately, not too many people attended today. There was only 1, 2, 3, 4, 5, 6, 7, 8, 9, like maybe 13 in total. So maybe tell your classmates that they should be attending the class. I know I do post the video, but still I would rather have, I don't want to have to stop doing that because no one's attending the classes. So anyways, have a great weekend, and we will see you next week. Take care. Have a